This is Corporate Warrior, high-intensity training lifestyle and business with Lawrence Neal, helping you improve your health and physique, become a great personal trainer, and start and grow your hit business.
This episode is brought to you by ARX, the most innovative, efficient, and effective all-in-one exercise machines I have ever seen. I was really impressed with my ARX workout. The intensity and adaptive resistance was unlike anything I've ever experienced. I love how the machine enables you to increase the negative load to fatigue target muscles more quickly, and I love how the workouts are effortlessly quantified. The software tracks maximum force output, rate of work, total amount of work done, and more in front of you on screen, allowing you to compete with your previous performance to give you and your clients real-time motivation. The ARX uses a computer-controlled motor to give you the exact amount of resistance your clients need 100% of the time. This means that the resistance can never become dangerous, is intuitive and simple to use, and can provide you with all of the results you and your clients are looking for in a fraction of the time. ARX is highly effective and efficient in delivering all of the benefits of exercise, including increased strength, muscle mass, cardiovascular conditioning, bone mineral density, and injury recovery. As well as being utilized by many high-intensity trainers to deliver highly effective and efficient workouts to their clients, ARX comes highly recommended by world-class trainers and brands, including Bulletproof, Tony Robbins, and Ben Greenfield Fitness. To find out more about ARX and get $500 off install when you place an order, please go to arxfit.com and mention Corporate Warrior in the How Did You Hear About Us field. So again, to get $500 off install when you order, head on over to arxfit.com and enter Corporate Warrior in the How Did You Hear About Us field. Lawrence Neal here, and welcome back to corporatewarrior.co. My guest today is Charlotte Pawar. Charlotte is the owner of Formations House. That's formations.house. Formations House are one of the longest running company formation and administration agents in the UK and operate globally to support businesses of all sizes. Their knowledge and expertise has meant they have formed more than 400,000 companies and file accounts for more than 500 growing businesses each year. They provide services for the business at all stages and support business owners to comply with UK and European financial reporting requirements. For some time now, I've had a couple of members in the Hit Business membership and also podcast listeners request more content on money management. So I thought it would be ideal to have a top-notch business finance expert on the podcast to address the challenges in running a small fitness business in the UK. So very niche indeed, and the questions were coming from UK-based business owners. However, whilst this is clearly mostly applicable to a small fitness business in the UK, the principles really apply across any small business or even medium-sized business in the UK, and even probably globally. I'm sure a lot of the stuff we talk about is relevant to many of those listening who might be in the US, for example, but obviously you do need to pay attention to your local laws, but I still think a lot of the principles will apply. This was incredibly vast and all-encompassing conversation. We literally cover every aspect that I can think of around company finance and accounting that you could possibly imagine. So a couple of things that we talk about include the pros and cons of being a sole trader versus setting up a limited company, pros and cons of owning a business versus franchising as you grow. We talk about optimizing business structure, how to source accountants effectively in terms of how to filter for strong accountants, and then also how to use them for maximum ROI. Not a lot of people really think about how they might leverage their accountants in the best way possible, and Charlotte gives some great insights into how you can do that in terms of planning together and making sure you get the most value. We talk about some of the biggest financial mistakes that startups make and how you can avoid those. And we talk about how to improve the business, the perception of your business, and how that can provide you with some enormous leverage, especially with banks. We talk about insurance, payment software and credit cards, banking strategies, claiming expenses effectively, and much, much more. For the show notes, please go to corporatewarrior.co/accountants. And now, without any further ado, I give you Charlotte Pawar. Charlotte, welcome to the show.
Hi.
It's a pleasure having you on the podcast. I don't get to talk to Brits that often because as you know, a lot of my audience are from the US. I do have a number of entrepreneurs and people in the UK and Europe and rest of the world that listen to this podcast. And obviously, specifically, we're going to be talking to and for the small business owners in the UK who have fitness businesses or high intensity training studios. I'm really excited about this because, as you know, as we've been talking about, when I first started my business, I really, really struggled to understand the finance and accounting side of it. I always found the resources online to be a little bit confusing and nothing really resonated with me. And so I'm really looking forward to just going through how to think about this from the perspective of someone who's just getting started, but also the existing business owner who's been doing this for a while, but looking to improve and optimize their, this part of their business. So we talked about certain things to cover in kind of an orderly fashion. Should we talk about, how you think about when it is best to be, a sole trader versus a limited company? And perhaps we can start with a sole trader and just dig into some of those points that we agreed prior to the call.
Sure. I think when it comes to, everyone has a different idea of how they want to run their business. Being a sole trader is very simple because you don't have to incorporate anything. There's no real registration. You are, in essence, just working for yourself. So the only real thing you ever have to worry about is making sure that when you do your self-assessment tax returns, that you include all of your income. There are some, obviously, lack of benefits in other ways that the protection of a limited company gives you. We would say the general rule of thumb is if you're going to turn over more than around 25,000 in a year, then you're probably best off with a limited company. If you're much smaller than that, then a sole trader is equally just as easy and simple for you to maintain and administrate. That the key difference between, say, a sole trader and a limited company is actually down to something called liability. So this is what a limited company is. It's called a limited liability company. And that means that if there is any debt or, say, for instance, a court judgment or anything on the company, or if the company is sued for something, the liability is limited only to what the company's share capital is and the director's own input. So if a director forms a company and he puts £1 in the company, which is very normal, and that company then later on has a court judgment against it, the most the director will ever lose is £1. If you're a sole trader, you don't have any of that protection. So that's the very, very first and foremost difference between a sole trader and a limited company. You have zero protection. Your personal finances as a sole trader are directly linked to your business. So if something happens in the business that you become liable, your personal possessions, so your house, your car, anything you own, your beloved bike, anything like that is up for attack, if you like. So it's a big thing to bear in mind. Now, obviously, in a personal training business, you're not necessarily going to have some of those obvious liabilities that a standard other, say, consultancy-based business or someone that's selling physical goods would have. But you do have things like insurance, and you have other things that you might want to consider. So it's always worth just looking at that first. How much liability do you think you might have in the future? Obviously, you always want to do a good job, but if you think that there may be a problem, you may have a debt where you say, a rental space, some money, anything like that. As a company, you're very much protected, whereas as a person, you're not. So that's the first difference.
One clarification. What is the significance? Why £25,000 as a kind of a rule of thumb?
Okay, that's more to do with taxation. So it's once you sort of go over that amount, you've got a kind of difference between the tax systems in the two structures, which is what I'll move on to now.
Got it. Okay.
So I just wanted to first sort of point out that the biggest difference between being a sole trader and a limited company is just that liability, because that's often not clear to most people. Then the next big difference is the way that you tax and the way that you account for yourself. So as a sole trader, everything you earn, you can then goes into your own personal income. So you have your usual tax code where you'll have, say, 10,000 or so personal tax free, and then over that you will pay between sort of 20 to 40% tax, depending on what tax rating you're on and how much income you have. There's a certain amount of the income that can be tax deductible, which are allowable expenses as a sole trader, which we can discuss later on. But essentially, most of your income is subject to personal tax, which is quite high in comparison to corporation tax. In a limited company, you pay 20% flat rate corporation tax only on your profits. So if your income goes over 25,000, but you can show expenses, including your own salary and other expenses. So for instance, travel expenses, renting equipment, renting space, anything like that, all comes off your income. And you could be left with, say, £1,000 or £2,000 of profit, and you just pay 20% corporation tax on that profit. It's quite common for small businesses in the first few years to not have any profit and to show literally just £1 or £2. The core break-even businesses, and this is very normal. So from a tax point of view, the 25,000 cutoff is really to do with where, as a personal tax, you'd probably go into a higher rating, whereas under corporation tax, you'd be much more efficient and optimizing what the tax liabilities for the business.
Mm-hmm. Cool. Okay, got it. Sorry. Please, okay. Yeah, please go on. Is there more on that particular point you wanted to elaborate on?
Not particularly on that, but I mean, there's once we sort of move through, what we would probably look at discussing is how the expenses in different models work. So there are some like for like expenses that are deductible in both business structures, but there are some that in a self-employed sole trader structure would be a lot more difficult to claim back, whereas in a limited company, it's a lot easier. Okay. The only other obvious difference between being a sole trader and a limited company is the ongoing costs. And those costs can be small or great, depends on how much of the work you want to do yourself, and whether or not you want to use your own address and things like that. So for instance, a limited company has to have a registered address in the UK, which is prominent on Companies House, which is public. So from there, anyone could see where you live if you wanted to use your home address. So you would typically use an address service provider, which would be an accountant or a lawyer, or there are specific address service providers who will charge you a nominal rate per year to use their address to receive all of your government mail and things like that. So that gives you a little bit of protection online, so that anybody who wants to find out where you live can't easily find out where you live. So you have that with a limited company. Additionally, you would probably want to have an accountant do your accounts every year. Not worrying about, say, what our charges are, but you would typically, even as a small business, pay around sort of £300 to £400 a year just to have your accounts done. So those are the costs on top. Plus you have something called government filings that you have to do. And if you don't do the filings on time, there can be penalties. So having a limited company, there's a little bit more administration and a slight increase in cost of operating. But the way off on that is, as a sole trader, you can't necessarily become as tax efficient as you could be as a limited company.
Oh, okay.
Does that make sense?
It does. It makes complete sense.
Okay. Fourth and final point on that is VAT. Sole traders can't be VAT registered, but limited companies can be VAT registered. So if your business is a certain size and you happen to purchase a fair amount that's VATable goods, you would be able to reclaim that. The downside is you have to charge VAT, so it increases your cost, which may not make you as attractive in the market, but in some ways it can make you more efficient and more balanced, because not everything is VATable. So some of the things that you're charging VAT on, or you're being charged on VAT on, you can reclaim, and other things, you wouldn't necessarily be collecting VAT back in. So the aim is to always VAT balance. But by being VAT registered, you can usually access different trade business registers and maybe even better discounts. So sometimes there is a benefit in being VAT registered. And
you have to have a certain amount of revenue to become VAT registered first as well, right? Is that correct?
Ideally. So there's a break threshold of 84,000. You can become VAT registered prior to that. And it's an interesting thing that people do. They will often apply to become VAT registered early on in their business because they know that they're going to purchase a fair amount of VAT rated goods. They can then reclaim the VAT on that. They can then apply to either deregister for VAT because they're not meeting the income threshold, or they file zero rate returns and eventually they get deregistered anyway because they're under the threshold. Right. It is done. It's not. It's kind of frowned upon, but at the same time, there's nothing wrong with doing it. It's perfectly normal and it's quite straightforward. People do it a lot, especially with small businesses.
What are the type of things that we can claim VAT back on. And I guess thinking about, fitness business, I'm just wondering, software, exercise equipment, machines, fill in the blank.
You're charged VAT on everything.
Right.
Well, you're charged VAT on everything. So the only things you're not charged VAT on is, I think, food. So maybe not your supplements, because I think VAT is only chargeable on hot food or food that has to be eaten in a restaurant environment. So things like any of the sort of food supplements and things, I think a lot of them are not VAT rated, or they're 0 VAT rated, or they're reduced at say 5%. But everything else, like your exercise equipment, mats, and things like that, are all VAT at 20%. So you're already paying that in your price without realizing it. But as a business, you can reclaim that. And if you import anything from Europe, you can also then not have to pay the VAT in the first place. Because if you're VAT registered, you can zero rate the transaction between, say, if it's a French company selling to a UK company that are both VAT registered, you just provide them your VAT number and then they remove the VAT off the order. So you're not paying it up front. So it's really good for cash flow, actually. And that's one of the big things that it really helps with.
Yeah, absolutely. What about if you're paying for services in America? Like, for instance, if you're buying software that's American?
Well, it depends on if they've charged you a sales tax. It's unlikely you'll be able to reclaim it because VAT system only really works across the EU right now.
Right, got it. Okay.
Yeah.
And so interesting. So again, this is, I'm sure, I feel a little silly asking this because I'm sure a lot of people think it's very straightforward. But just for clarity, so this is obviously an enormous benefit if you are VAT registered or it just makes you much more. It's like another cost saving that you can take advantage of when you're at that level. But until you've got enough revenue to become VAT registered, it's something that you can't really capitalize on.
No, and you can't. So you have to pay that amount up front. There's nothing really you can do about that from a cash flow point of view. As I say, you can request to register for VAT prior to reaching the threshold because you can state that you intend to make enough sales or purchases. So turnover is a general term. It doesn't need to be income only. It can be purchases too. So if you think you're going to purchase more than, say, 84,000 in a 12-month period, you can then apply for a VAT number at that point. But if you're not going to meet that, then there's no difference between you being a sole trader and a limited company at that point because you're paying the same price. Right.
Okay. Got it. Anything else that comes to mind in terms of the difference between being a sole trader versus limited company and the pros and cons?
Cash
flow management, I think we've got as a point here, but I'm not sure if you sort of somewhat covered that to an extent.
Yeah, I think I can't think of any other major differences. As I say, for me, the major difference is the liability, which I mentioned right at the beginning, and the fact that you can be a little bit more tax efficient with a limited company with what you can reclaim and things like that. Whereas with a sole trader, everything is your cost. You whether you pay for travel or whatever, there's only a certain amount that you can deduct. Whereas if it's a limited company, you can deduct a lot more for travel expenses and even things like that. So it's a lot simpler. In terms of the VAT and cash flow, that really is dependent on the size of the business. And if you were already at that level, you would want to be a limited company and not a sole trader anyway.
This sort of takes me back because I remember I when I was sitting down with my accountant and having a conversation over sole trader versus limited company, she just kind of bamboozled me and confused me. But I know she's a lovely lady, my accountant, and has always got my best interests at heart. And it's been a great relationship since we've been working together. But that doesn't mean that I don't still get confused when she talks to me. So I believe, and now it's kind of making sense to me listening to you why I became a limited company rather than starting as a sole trader, because I was working in tech sales in London. So I had a full-time job and I had no intention of paying myself from my business because I didn't want to have to pay the crazy amount of tax that you pay as a second income. And so she kind of took that into account and decided that it would be more sensible for me to become a limited company. I think that was one of the reasons. Again, Charlotte, correct me if this is not making sense. And I think there was also the fact that I'm trying to think now. It was also being able to claim, I think, certain expenses that were related to the business which I might not have been able to do as a sole trader.
Exactly.
Is that logical, I guess?
That's one of the big reasons why you would have a limited company. She's very correct, because you already had an income elsewhere. If you started as a sole trader, your combined income would be taxable from both businesses. Whereas if you have a limited company and you channel the income from the limited company only to that limited company, and you yourself don't take a salary, you can claim director expenses, so travel costs incurred as a result of the business or things that you've purchased on behalf of the business. You can even include expenses in setting up the business or things that you purchased for the business before it even officially started. Mm-hmm. You can include all of those in the tax book or the financial book of the business rather than you yourself. So it makes it a lot simpler and clearer and more efficient for you personally with your tax, because you would have then gone into the higher rate and would have been paying a lot more tax, even if it was income that you didn't really have profit on. And at the end of the day, running the business, whether you're a sole trader or a limited company, the whole reason that you run a business is because you want to be profitable. Yes, of course, obviously you do it because you enjoy the job and all of that. But from an accounting point of view, you run a business to make profit. So the best way is with a limited company, the way that you can see the profit is clear. With a sole trader, you can't, because you have to then be very, very defined and very strict with yourself on separating your personal expenses and the expenses of the business. And most people would find that very difficult to do. If anything, they would probably end up having more administration time spent than if they just had a limited company.
Yeah.
One other thing just did pop to mind, actually, which it's because you mentioned tech. So it's not a direct relationship to this industry, but it could be. So where you have fitness people or personal trainers who develop their own skills or technique, or for instance, they have a trademark or a name, it's a lot better as an asset to have that intellectual property is what we call it. So whether it be a trademark for, say, a move or something they do, or a piece of equipment or a design, if they want to innovate, or, like a patent, it's a lot simpler to have that registered under a company. And it means that if you then want to sell it on later on, you can sell it with the business as an entire kind of asset. Whereas you can have those things trademarked to yourself personally, but as a company, it gives you a little bit more strength and actually a little bit more better market visibility. So it's another kind of slight benefit of having a limited company over being a sole trader is if you ever want to have any intellectual property, it's a lot easier as a company to do so, to have that.
I mean, is it fair to say though that if you are a sole trader and you're doing this stuff and you maybe create some intellectual property, that you can always transition into becoming a limited company and then taking advantage of those same benefits? Is that fairly straightforward?
I think so. Yeah, I mean, if you're going to be a sole trader, it's really only because you're either running the business on a very small scale and it's part-time, for instance, it's not your main source of income. Any other situation, a limited company is better for you. If it's going to own assets and you're going to publish those assets, then being a limited company gives you a little bit of protection, especially if there could be liabilities later on. Also, if someone then, for instance, tries to use your assets, it will feel a lot stronger for you suing them as a company than as a person. So it's a public perception as well.
I wonder if it's probably going to make sense now to jump on to the group structure point / franchising before we go into the categorizing expenses and stuff like that. Okay. Do you want to just elaborate on your thoughts around group structure and franchising and that kind of thing?
Well, so if you have the type of business model that's easily replicated, that's what you call a franchise. And there's two different ways that people often run franchises in the UK. Is they'll either sell, say, for instance, their brand name with under a new company, and it will be issued to somebody else who will own that company as a director, and they'll own shares in that company. But they will have right to use brand name. They'll have right to, say, for instance, use certain equipment, or they may be able to access wholesale buying rates or food supplements, something like that. So that's what you would call a franchise. That's actually operated as an independent business to the main limited business. So they're two separate companies, not linked by ownership. Okay. That works well, as I say, in certain environments where they are selling themselves as a brand, but they don't want to be running a second business. They want someone else to run that business and them to take ownership in it. Where you may have a group structure is where you want to have several sites and you want to own them, but you may not be the manager for each of them. So you might say, I own company XYZ and I'm and I want to have company ABC as, say, a sub-office. I'm not there running it. I don't want to be the director, but I've invested in it and I've set it up. So you could make company ABC in a subgroup within a group of XYZ Company Limited. So it would own it, in essence, meaning it would have a right to the profits in the smaller company in ABC. Mm-hmm. So when ABC trades and it, say, makes £30 in profit, £10 of that profit could go back to XYZ Limited. XYZ Limited didn't really need to do any work to make that £10 profit. All it did was form this ABC, which somebody else is running. It has its own cash book, has its own accounts, but it receives an income from it. And that's called a group structure. And a lot of people will do that if they do want to run multiple branches of their business, or they want to work with, so if there's multiple locations and you have, say, lots of friends in your industry and you want to link and work with them but you don't want to be financially tied to them in terms of liability, you might have a number of independent companies, but you put them all owned by one single company, which benefits from them growing.
Right. Okay. Got it. Are there any considerations in terms of, I guess, the accountancy side and the financial side, whether in your mind, whether a fitness business may decide to grow in the way of a group structure? So I guess ownership of the different entities versus franchising out. Is there any kind of considerations in terms of accounting or financial perspective that come to mind, or pros and cons?
Yes and no. From experience here in London, I've got a couple of friends of mine who run small gyms, and they actually run them as franchises. So they have, say, 5 or 6 branded dojos around London. And what they do is each one has its own company name. The director, however, is the same for each of the 6 companies. The shareholders are the same, but each branch acts as a separate franchise. So it trades under the kind of dojo's name, but it has its own income, its own cost book, its own employee book. They're not transferable. So that means that he could then easily see which of his branches is more profitable than the other, but also if one is more profitable than the other and it's paying tax at a different rate, it doesn't then affect the taxation rates on the other 5. If he was doing it as a group structure, then all the income is being ploughed back into one single company, regardless of how profitable each of the 5 or 6 branches were. They all go back into one main company, which is owned, say, by the one person at the top end. And then he's paying tax on all of them, on the profits of all of them.
So what? Okay.
It's quite complicated, actually. But now I'm realizing, as I'm saying it, it's quite a complicated structure to explain. And I think what it is, we generally do it on a case by case. So if you had a personal training business where you had your own equipment and it was all branded and you wanted to create a brand in the industry for yourself, you would do that as a franchise, because you're not able to be in more than one place at once, but you would like someone else to sell your way of training. So you would then sell the concept of your training almost as an asset to someone else. They would incorporate their own company and they would pay you a franchise license fee, and that license fee becomes your income, which is great. But you don't actually have to run that company. You're not liable for any accounting, any tax, any administration of that separate company, because it's run as a franchise. The only thing you're liable for is ensuring that you meet the agreement of the franchise, which might be to supply X number of branded T-shirts per month, as an example. Yeah. If you were running it as a group structure, instead of a franchise, then you have liability in a way, because if that smaller company, that second company, goes on and has any kind of debt, or it has some other problems, or for instance, it becomes unprofitable very quickly, then you as the owner, the ultimate owner of the company in the group structure, are liable to make sure that smaller company meets its obligations.
Yeah, very well explained. No, that was very clear. So no, I appreciate that, and I can see why one business owner might go down either track. Clearly, franchising is more straightforward, but I think there are maybe non-financial, more brand consistency and procedure consistency goals that might determine someone actually does want to do ends up doing a group structure and owning every location, so that they can ensure there's a consistent service and business
quality.
Quality. That's the word.
Yeah. The other side of it is, if, for instance, you want to run 3 symbiotic businesses, so you might have one business that does actual personal training, provides a service. But you might separately want to have a business that just sells branded goods, and you might separately have a business that sells food supplements, as an example. And you may want to keep the three businesses separate in terms of income and bank accounts, but ultimately they feed their profit back into you as the owner of all three, and you want them to operate under a brand name. So this is a very good way sometimes where you have the services side of the business. And this is where VAT is going to come back into our conversation. So the services side business, you wouldn't want to charge VAT because it makes you less cost effective to your clients. But on the, say, for instance, the branded goods side, if you're charging VAT, customers are used to paying VAT anyway. They don't even notice it. When you buy a T-shirt, you've already paid the VAT, but you can reclaim your VAT costs too. So it makes you slightly more cost effective. So you might have a group structure where company A owns company B, C, and D, and company B doesn't have VAT number and it just trades selling its services. And company C is VAT registered. It goes over its threshold and it's able to then reclaim the VAT that it's charged and then balance that from the VAT that it charges its customers. So you'll have sort of which is better than just paying VAT all the time and not being able to reclaim any of it.
Right. Okay. Yeah, I guess. So
that's another example of how group structures are often used. If you are running three businesses that are kind of linked, or two businesses even that are linked, but you would like to account for them slightly differently. So the VAT, especially in those cases.
Yeah. Obviously, just for those listening, I do think if you end up starting a limited company, I do think it's ideal and advisable to engage with an accountant to help you work this out. But I think this is still really good insight into the various options available to a new business or an existing business owner or one who is looking to scale. It's funny because I guess with whilst there are upsides, like you just mentioned there, in terms of the VAT piece, I suppose this might be kind of obvious, but in my mind, I'm thinking, wow, 3 different businesses under a brand, like that example you gave, that means, like you say, multiple bank accounts, like you're adding more complexity, but I guess for potentially the right reasons. And some people might like to just separate things out purely from an organizational point of view. But it's an interesting thought experiment to think about what makes the most sense.
Yeah, some people would want to do it just for public perception too. Makes them look like they're a much bigger company, a much bigger outfit. Right. It really depends on where they are in their business life cycle. Because your listeners are from, startups themselves, perhaps they're either limited companies already or they're transitioning and they're not sure where they want to be, or they've been trading for 2 or 3 years and now are getting actually quite big. They may want to look at other options. And that's where you really do need to sit and talk to your accountant and say, okay, this is what I want to do in the next 5 years, or even 10 years if you can. But 5 years is a good kind of grasping point. And then most accountants or good accountants would then be able to say to you, okay, well, what I would suggest is if you're working towards that goal in 5 years' time and you want to have, say, multi-brand or multi-branch, or you want to have, a franchise model or anything like that, then right now, let's start positioning your business here. And then let's look at incorporating a secondary business here and putting all of the IP or the assets, intellectual property in that separate business if you wish to, for instance, sell it as a branded label or whatever that might be.
That's really great advice, because I think a lot of business owners really just operate from year to year. They might set goals, but they might not share those goals on that roadmap with their accountant. And I think that's just so important to relay that vision so that they understand where you're headed and how, and they might show you what the roadblocks might be from their perspective leading up to that. I think that's a really good point. And I guess just on that, as a neat kind of segue into talking about some of the do's and don'ts for some of my listeners. Have you got any thoughts on, in your experience, what are the kind of do's and don'ts, the kind of pitfalls you see in some of the fitness businesses that you've worked with before, in terms of mistakes they make in the early days when it comes to this type of thing and it comes to the financial accounting side of their business? Is there anything that comes to mind?
I would say it's very similar for a lot of businesses, that in the very early days, I think it's not always clear what you can then later on reclaim. So one mistake a lot of business owners make is they will spend a few £100 setting up their business. Before they have the limited business number, or even if they're a sole trader, before they actually start selling, receiving income, selling their services, they will have spent money on buying either equipment or incorporating the company or renting an office. And they often won't include that as an expense once the business is operating. In their mind, expenses of the business are only from the day it's actually selling something, or that it's actually incorporated. And actually, you can use all of the costs from beforehand to bring down your first year's profit, because the aim, although I said earlier, the aim is to always be profitable, your aim from a tax point of view is to be efficient. And so, of course, you want to show the least profit overall. You want to have high income, high turnover, lower profits. And the only way to do that is to really include all of the costs that were there for you to set up the business. I think one of the other misconceptions, which is in all businesses actually, is where travel fits in. So your cost of travel and how you can reclaim it. I think it's not so much a discussion on allowable expenses, but it's about thinking, if you're going to, for instance, and I come back to you here because you mentioned something in our previous chat about if you have a bike. If your business buys the bike and the bike is used for business purposes, then it's not only an asset of the business, like a car has an asset value, a bike has an asset value. So it goes on your bottom sheet, makes you look better. But also it's easier to reclaim the cost of, say, maintaining that bike, as an example. Whereas if you don't do that, if you go and buy it personally and then you use it for business and then you try and say, well, I had to replace the inner tube. It may not be expensive, but I had to replace the inner tube and I had some costs with it. But it's your personal bike, so why would the business pay for that? How can you then include that cost in your business cost? You can't.
Yeah.
So that's one mistake people make. And if you're going to have a bike, or you're going to have a car, or you're going to have something that's going to predominantly be used for you to get around in business, and for personal trainers, it's quite specific because you do travel around a lot. You're not always in one location. If you go to visit your clients or you go from different gym locations, then you're going to have a mode of transport. Then it's something to consider. If you can buy it under your business name or as a sole trader name, you can still actually say that you've bought it specifically as a sole trader and put it down from the beginning as a sole trader expense. Then it's a lot simpler in the future. So that's one main point is things like owning assets and working out how best to make an allowable expense of those assets. From the very beginning, you need to be clear on it so that you can then make the most of it.
Well, yeah, no, absolutely. Excellent point. And you're making me think now, because I actually had my bike serviced and I paid for that out of my personal money. And now I'm kicking myself, even though it's only, €30 or whatever. Because I'm
but it adds up at the end of the day. All of these things add up. So.
That's right. And I guess, on that point, you're talking about things that you can pay for with your business and expense for your business. What I think one thing, and I certainly personally, I had to sit down with my accountant and actually go, okay, what can I actually claim through my business? What is considered a business expense? Can we talk? Because I think a lot of people, a lot of business owners don't, or new business owners especially, don't know what they can actually claim through their business. So do you want to talk about, I guess, the things that we should be expensing for our business, generally speaking?
Yeah, we can do. I mean, in general, anything that you need to run your business. So first, that's just also one point I think I didn't say. Whether you're a sole trader or a limited company, but especially if you're a sole trader, the first thing you should always do, though, is go and get a separate bank account. And so that it's very clear for you to account separately for all of the business. Anything that you buy and sell goes through this separate sole trader. Because obviously, if you're a sole trader, it's in your personal name. But make a separate bank account. Don't use your primary personal account. And obviously, if it's a limited company, you'll have a separate bank account. So that's quite useful. And then your expenses can go through there. So if we start with, for instance, home working, I work from home 1 or 2 days a week. And so it's often something that people feel that if they work from home, they can reclaim a lot of the costs. You can't actually, there's a sort of cap on it, on how much you can reclaim for things like electricity, gas, rent. It's very much capped. Whereas if you register your business at your home address, then it's a little bit more flexible because, but you have to be careful you don't end up paying business rates, because if you're actually operating your business from a residential address, you'll pay business rates. So it's another reason why a lot of people have what you call a virtual office or a registered address service that's separate to their home address. So it's very simple. They don't end up paying a business rate when they don't really need to. So that's the first kind of expense.
Just to interject quickly, does business, so for things like, let's say, first thing that comes to mind for me would be like utilities, like electric and gas. Does that tend to be higher if you do it as a business versus a residential?
Those costs shouldn't be higher because a building is a building, but you'll pay different council tax rates as a business.
And does that net out as higher or?
Yes.
Right.
Yes.
I see.
You pay business, but business rates are high. So if you're obviously living in a house and you're paying residential council tax, and you say that you're operating your business from there in order to reclaim most of those business costs. So for instance, your rent and your electricity, you could then reclaim if you're operating your business from there, but then you'll be paying business rates to the council, which may outweigh the benefit of putting those electricity costs, for instance, through. So you've got to look at it on a case by case, almost find out what your business rates are in the area. But 9 times out of 10, it's better to stay residential. And not try and claim working from home rates and sort of charge yourself, because what people try and do is they'll use their company to invoice themselves personally for rent. Or sorry, the other way around. They themselves personally will invoice their company for rent. So I will say that I'm invoicing my company £200 this week because you used my office one day. But that's not allowable. Okay. And you need to be very careful with that.
Just on one other thing I wanted to ask you about what you said just now is regarding those caps. So when you say that, what that means to me is that there'll be a certain amount, a cap that you mentioned there, which you can fill that, and then when you come to do the accounts, you'll put, let's say you maximize that, then you'll put whatever it is, let's say £500 for the year, and that will go in your balance sheet.
The cap's much lower. It's £104, a whole £104. So that's the cap. If you work from home, you're only allowed to reclaim £104 at the end of the year from using your home as an office. Oh, wow. So it's not a lot of people don't know this, and it's a big mistake. And a lot of the time it's overlooked. HMRC won't ask you questions, but you don't want to be in a situation where if they do come and ask you to prove receipts and expenses, they look at that and go, oh, hang on, here you've got an expense for rent, which is X amount, but that's into a home address. If you pay rent to a third party, that's a business address, that's an acceptable expense. Your business is going to pay rent to someone, but if it's being paid back to yourself at your home, they won't allow that.
Of course. Interesting. So I was going to dive into a bunch of questions in terms of what you could expense from your home office, but now I think that's completely pointless in that the value that you can actually expense is so low.
Yeah, it's very low. It's very low. Again, you can't. You can. So if you buy a desk for your home office, you can expense it, but the desk belongs to the company, not to you. So you can buy a computer for your home office, you could buy a printer for your home office, all of those things, but they belong to the company, and they go on the company's balance sheet as an asset, which depreciates, but it's still an asset. Mm-hmm. But you can't, for instance, go over that £104 end of year threshold for reclaiming electricity costs and things like that.
Yeah, and I guess this probably sounds like a silly question, but you buy I have a laptop, but that's not deemed a home office piece of equipment. That's just an asset within the business. So
if you use it for work predominantly, it's a business asset. Yeah, it's owned by the business, which means you can then put it under the business insurance usually as well, which is usually a better rate than say, or home contents. So that's really down to whether or not you want to put those goods under home contents insurance or business insurance.
This episode is brought to you by our sponsor, ARX. Are you looking to create a cutting-edge, high-intensity training facility? Are you confused on what equipment to use or how to separate yourself from the masses? Well, then ARX Fit might be the answer you're looking for. I asked Mike Polano from ARX a few questions about how ARX machines are challenging the status quo of the exercise industry around the globe. Mike, if you could Give the listeners a quick summary of why ARX is so different from the traditional machines or tools they're used to seeing in most exercise facilities.
ARX is totally different than anything you've seen before. This isn't just another weight stack machine. We've looked at the last 40 years of exercise technology and used that knowledge to create something entirely new. ARX uses a new form of resistance, a motor, and we pair that motor with computer software so that we can maximize the safety, effectiveness, and efficiency of your workouts. So you may be asking, okay, but how does ARX compare to weights? Traditional machines you see in gyms today are based on lifting metal weights and battling gravity. What people don't realize is that when you're forced to lift a static weight like this, one that doesn't adapt or change while you use it, you're underloading yourself rep after rep. And this unnecessarily limits your ability to make improvements. With ARX, we've taken a totally different approach. We removed weights and gravity from the equation altogether. Instead, ARX combines our patented motorized resistance with our custom computer software to provide you with the world's safest, most effective, and most quantified form of resistance training ever. When you train with ARX, you are training to your perfect level of resistance, both positively and negatively 100% of the time. No more guessing what weight to use. ARX does all of that for you, instantly and automatically. We'll also track and measure every second of every rep, so you can quantify all of your workouts to find out if you're improving and by exactly how much. Whether your goals are bigger muscles, increased strength, stronger bones, or just to look good in a bathing suit, ARX can help you achieve all of these and more, but do so in a fraction of the time it would take compared to traditional equipment. If you're looking for the most efficient, most effective, and most quantified piece of exercise equipment on the market today, then look no further than ARX.
Thanks, Mike. That all sounds really impressive. If you'd like to learn more about ARX, visit arxfit.com and mention that you heard about ARX on the Corporate Warrior podcast to receive an exclusive deal of $500 off shipping and installation off your ARX machines. I'm just thinking, some of this stuff's become really pertinent to me. In terms of the account structure, you might have already answered this as much as it needs to be answered, but, I bank with Santander, and I have a business bank account with them and I have a personal account. I live in Ireland, but I tend to use a Zero credit card, which is an international credit card, to use money from my personal account. I found that based the way things are for me at the moment, I don't have an Irish company set up, so it's the most efficient way I can think of doing things right now. Now, I guess I'm just curious. What are your thoughts on best practices for, I guess, setting up different accounts? I guess it probably differs quite a lot between businesses, and I do want to keep this as much as possible in a kind of a fitness business context. So have you got any kind of thoughts on best practices in terms of the account structure?
Well, I would say from business banking, whether you're a sole trader or not, banks like Barclays, NatWest, all the modern high street banks, they all allow you to have accounts that you can access through your single online login, which is very useful. So it means that you can log into your personal account and see your business account as well at the same time and manage it. In terms of having a business account, so every business account can issue you a debit card, and then there are card service companies, like for instance Pleo Card. I mean, I don't know them that well or anything. I'm just stating ones I know off the top of my head, where you can have prepaid cards, and the good thing is you can then auto load them from the business account, and then those cards can be used for expenses while you're, for instance, traveling or out and about, and then it just shows in your accounts as expense top up onto your card, onto the prepaid card. And that card is specifically in the business name. So if you have multiple employees, or if, for instance, if there's a couple of you that run the business together, then having those top up cards is quite handy, because then it's not directly linked directly into the business account. So one of you can't accidentally buy £2,000 worth of equipment when you didn't mean to, because it's limited to whatever's on the card. So you can control your cash a little bit better. But at the same time, you have the flexibility of having a credit type card, prepaid card in the business name. So I would always suggest doing that. I would always suggest have a separate business account, get a debit card for that account, but in addition have some kind of prepaid top-up card that you can either use for yourself or to any employees or other partners in the business.
Interesting. So these cards you mentioned, again, I'm looking at, I suppose I'm now shifting over to my personal situation. You know, if I wanted to do that, I would need an international card that was connected to my business account for expenses, which wouldn't charge me a commission every time I used it outside the UK. Do you know if that exists?
Well, you're talking about that there are lots of card issuers out there that are international based. They'll all, I don't know of many that don't charge any commission, but they're under the MasterCard and Visa schemes. They're generally quite good commission rates. They won't charge you a lot. With business accounts, so we as a business, from our point of view, so we have 3 different business bank accounts, and one of our accounts is what we call a corporate banking account. Now that already has dollar, euro accounts associated. So when I make payments from that account, whether it's on a debit card or a credit card or anything like that, they're made in the currency from the currency account. So I'm not paying, transfer commissions and things. It's automatically done that way. But you would want to be a business of a certain size to do that, because you pay accounting fees to the bank to maintain accounts like that.
What would be the minimum sort of, size you want to be before you consider something like that?
I would say it's more about how often you're making payments, say, for instance, in euro and pounds. So if you're making more than £25,000 worth of purchases, or even receiving more than that in either currency, I would have separate currency accounts. And all of the high street banks can do that for you. They will all very happily open you a standard GBP account, which is what you would get when you apply in the UK. And then you just request for them to open you a euro account. Bank charges vary, obviously, but for instance, Barclays, I think it's, I'm probably going to be completely wrong here, misquote this. I think it's about 20 quid a year, something like that. And then there's like a £6 per month service fee. And basically that just means that you can then receive money into the euro account directly and not pay, the Forex charges. And then when you want to make payments out in euros, you do it from your euro account. And it's all managed in the one interface. So it's very easy from a business banking point of view to do that. Then you can have cards issued for those currencies. Mm-hmm. So you would go back to Santander and ask them to open you a euro account in addition to your GBP account, and ask them to issue you either a debit card or a prepaid card for that euro account. Or you would go to a third-party card provider like, as I said, Pleo. There's quite a few. I can separately kind of list out some on another, in an email or something, and just say, because there's a few that our clients work with, so I see them come up when we're doing their accounts, and I see them top up. So that they will charge you, say, a set amount of commission or card management fee for the year, and then you can just load it up with 1,000 at a time or 500 at a time, whatever it might be, and then you load it up in the currency of choice.
Interesting. Oh, that's very useful to know. Okay, so I guess reverting back to addressing the listeners' business models.
Okay.
I think I'm still really going to ask questions for myself, because I do think it's relevant across multiple kind of industries. Going back to this talking point around expenses. What else is there that should be that we are able to add into that category in our kind of balance sheet?
Okay, so there's the obvious things would be, so for instance, memberships to certain professional bodies and associations. So as a personal trainer, you may be personally a member of those associations, but your company can also then be listed, or you can go and have your listing edited, for instance, to include your company. At that point, it can then be a business expense, because you are required, for instance, to be a member of certain associations in order to operate. So you put it on there on your business expense. Then you've got things like insurance, and then you've got things like clothing, equipment that you need to buy. It can be consumable items that you need in order to run the business that you may have before just bought, not thinking about, things that you wouldn't typically have a big receipt for. You might have just one of those quick printout receipts. Start keeping those receipts and accounting for them as a business cost, because at the end of the day, you do need to buy them in order to operate the business. Mm-hmm. Then there's interesting expenses, what we call things like subsistence. So you can't obviously put your food bill on your business, but there's certain things that you're going to buy. So if you have to travel, for instance, to provide training, and you get there, and while you're there, you need to buy certain food, or you need to buy something in particular that's a consumable, that's a business cost. If you are trying to I don't know of an environment where this would necessarily work, but in other business environments where you're, say, talking to clients or suppliers and you want to build a relationship with them, you might go out for dinner or lunch or just grab a coffee. That then becomes an expense, almost like marketing, because you're using it's your time spent on business purposes, and those are things that you've consumed or required during working on business purposes. Does that make sense?
It does.
Yeah.
Yeah.
Then, of course, equipment. I've mentioned repairing those equipments and things like that. That's the main things. Marketing costs, which most people would know would be a cost of the business. And then there's some other accounting lines that you can include. So I mentioned before that sometimes with a limited business, your income isn't that high enough for you to take a personal income, to take a director's income, a salary, if you like. So what some directors do in order to be able to live for the first, say, year or 2 years while their business is starting up and in its early stages is they might take something called a director's loan. And that will be a payment from the business to the director. And that could be a set amount every month. It's nearly always the same amount for a particular period of time. Now, that loan is interest-free. The loan is not taxable. But at some point in the business's lifetime, the director needs to pay that loan back to the business.
Right, okay.
So that's quite a useful early stage part. So if you've just started up your limited company and the limited company is making some money, but you can't really take a set salary, which you would then, of course, pay income tax on, national insurance contribution, all of that, because you do that personally. But you do need to have some kind of additional income from the business. You could choose, so long as it's properly put in the accounting, to take it as a director's loan for a set amount of time. And that loan is then you can take it monthly or as a one-off amount from the business, so long as you commit to repaying it at some point in the business's lifetime before the business closes or sells.
Do you know what? One thing that going into this being incredibly ignorant about accountancy and just basically running a business is how it's silly things like how do I pay myself? Like, what do you how does that happen? And I might not even do this in the most efficient way now. And I'm sure if you looked at the way I do things, Charlotte, I'm sure you'd probably point out some inefficiencies. But what I've kind of come to realize and correct me if I'm wrong about any of this, but a lot of this stuff is like kind of happening after the fact. So, if I pay myself, so I transfer X amount of money from my business account into my personal account, my accountant knows that is salary or that can be defined as salary. So the way I operate is she'll look at all of my transactions across everything when she comes to do my accounts, and she'll then categorize it accordingly. And if there's any tax owed or anything like that, that's when that's handled. Is that best practice, or is that should I be operating differently?
There's different ways of handling income tax in a business. So as a director, there's three ways that you can basically receive income from your business. So the first way is you become an employee of your business. So you go on to PAYE, pay as you earn, which is tax, which is what, if you worked for any other company in the UK, you'd probably be already doing PAYE. So you get your monthly paycheck and it will have your gross amount. Then it will have deductions for income tax, national insurance, maybe pension or something else, and then you get a net amount. So that's how you'd be paid in any other business, and you can choose to pay yourself that way in your own limited company too. So every month, then your business then needs to send a certain amount to HMRC, which covers the tax contribution on your behalf. So the business pays your tax on your behalf. You don't get it in the first place. So you're still paying the tax, but it's not something you have to do yourself. The business does it for you, and therefore your accountant would do it for you, or you can do it yourself if you choose to. If you have multiple employees, then you would probably want to do PAYE, so that every month the income tax that's paid on behalf of that employee is sent to HMRC, and then it's usually quarterly. You would do the national insurance contributions on behalf of the employee, and the company pays that from their business account. So that's one way. Second way is where you take an income from your company yourself every month, and then at the end of the tax year, but your tax year, not the company's tax year, you do something called a self-assessment. And in that self-assessment, you tell HMRC that you took X amount from your business as a salary, as an income. They will then calculate your income tax based on how much you say you've taken and any other earnings that you have. And then they will then say, okay, this is now how much tax you owe. And then it's up to you to make that tax payment. And on a personal tax point of view, it can be quite complicated dealing with self-assessment, to be honest, because they do things like waiting payments, and then they do like a half yearly payment that they'll expect from you called a balancing payment, which is in anticipation of your following tax year. So you'll say in 1 year that you earn X amount, and then they'll assume that the following year you're going to earn X amount, and they'll ask you for the tax in advance for that following year, and it goes on your tax bill and you kind of have to pay it. So it becomes stressful doing self-assessment, but your accountant hopefully would do all of that for you and make it a little less stressful. Mm-hmm. And then you make your national insurance contributions directly. So it's not done through your business. You do it all personally. Then there's another way, which is called dividends. So you don't take a salary. You take an income in the form of profit share. So a limited company is owned by shares. And every share, although it may have a nominal value of £1, the number of shares equates to how many pieces of profit are left over. So when the company has paid all of its costs and it's paid its corporation tax, whatever amount is left then goes to the shareholders, the directors, in the ratios of however many shares they own. Normally it's one director, one shareholder, so they get all of whatever is remaining. That's your income. So again, you need to put that on your self-assessment, and you pay tax just on that profit dividend and any other dividends that you might have. You can choose not to take that. You can choose to keep it in the company and not collect your dividend, and therefore not pay tax on it. You reinvest it in the company, and it actually then goes on the balance sheet as a director's investment, meaning in essence, it's money that you can hold for later on in the business. A lot of people will use that to grow their business in the early days, mm-hmm. and then take that money out later on when the business is very self-sufficient. So those are your three main ways. And then in addition, the director's loan, which I mentioned already, which is done as an expense. Each way has benefits, but equally they're all fairly complicated. The simplest way, the way that most people do it, is they just take a set amount every month, and then they do their self-assessment at the end of the year, and they hope for the best. So I say that jokingly because you go back 2 years ago or 3 years ago, self-assessment wasn't that big a thing. I mean, there was lots of marketing on the TV about HMRC saying, do your self-assessment. But people assumed that was for when you are just self-employed, not even a director of a business, that you just, for instance, high-end financial consultants that earn huge amounts of commission. That was what you thought self-assessment was for. Now it's for anyone that owns any business. Even if the business is dormant, you still have to tell HMRC how much you've taken from your business. If you're a director, you need to tell them what income you've got. So you need to do your self-assessment every year. And there's deadlines through the year to do that.
Yeah, my accountant's always quick to tell me when those deadlines are. This is really valuable because, I remember when I first started paying myself a salary, if you will, and we kind of decided that because at the time I was kind of using savings to live on. I wasn't making a lot of money through the business. A lot of it was being reinvested to grow the business. And then I got to a point where I was like, okay, I really need to start paying myself a salary. But we decided that I would pay myself minimum wage to be as tax efficient as possible. Mm-hmm. But what ended up happening is some months I wouldn't pay myself at all. And then like 1 month I pay myself maybe double. And then, but it would net out at the end of the year to be, at or beneath minimum wage. So it was still the same, tax efficiency benefit gained. Is that correct? Is that reasonable to do?
That's how a lot of people do it. Yeah, okay. A lot of people do it that way. They do, or rather, you take money when you need it, because if you're starting a business or your business is quite young, then your whole idea is you want to keep as much money in the business as possible to help it keep growing. Right. So you don't want to take a huge salary out of the business. So therefore, you generally will just take the absolute minimum that you need to take in order for the business to continue to grow, but also for you to have some kind of living cost. And so based on that, you would then file your self-assessment based on what you've actually taken from the business. You don't have to take a profit. You don't have to take a dividend. There are some personal taxation kind of other things that some people do, but they're quite complicated. And again, an accountant at the time that she's preparing your self-assessment would probably ask you things like, if you've worked less than 16 hours, for instance, we can reduce your tax liabilities because of that. So it depends on how many hours you're working in a week, what kind of income you are taking. Those things will all be considered first before saying, okay, this is what we're going to tell HMRC that you've taken, and this is going to be your tax liability on that on a personal level.
Cool. Yeah. No, this is very useful and interesting, and yeah, it's just good to be able to bounce these things off you to figure out what's legal and what makes the most sense for sure. What are your views on? I mean, I use a piece of software called Xero, Xero, to integrate, because I take money from Stripe, and Stripe goes straight into obviously my business bank account, but PayPal, although I'm told it's really a payment gateway, not, I think people use it as a bank account, but really, I think PayPal don't really call themselves a bank account.
It's because they don't have a license to do that.
Right.
They're technically not supposed to be a bank account, but they have a wallet service. So a lot of people will use it as a PayPal for Business is great. Stripe is very good. Stripe is good because it's very low cost. It's easy to integrate on any site. But the only sort of downside with Stripe is the time from transfer. So it can take, I think, 6 or 7 business days sometimes to receive the transfer payment. So it's a bit slow for a lot of small businesses, because cash is king early on in the business. You want that money in your account very quickly. So PayPal can be better. Bax payments and online banking now is so quick. People having mobile bank accounts. For instance, in that West app, I can log in and I can pay a small business. If it's under the £250 threshold, I can pay it straight away from my phone. So going forward, I think business owners, when they just have a standard business account, can ask their clients to pay them that way, and therefore A, avoid merchant fees, B, get the money straight away in their account. It's a little bit more secure as well. PayPal is useful because you can see the money straight away in your account. It's there, it's cleared. So it's that instantaneous, whereas with Stripe, you're sitting around waiting for it, even if it's been authorized.
So just to clarify then, I'm thinking about, if you're started up a personal training studio and talking about this, the most efficient ways to take payment. Can you just elaborate again on what would be the fastest? I guess maybe we can talk about ranking the different kind of methods of transaction. What would be the most efficient, but also the fastest in terms of getting the money in as well? As you said there, cash is king. So what?
Well, this is not strictly accounting. We're really talking about actual business operation here, which we can talk about. More than happy to talk about it, but it's not. So we can't really give a definitive ranking, because everything is dependent on the actual provider at the time, and I may not be able to sort of think of the immediate provider. But if I was to take a typical traditional one, so firstly, let me just also clarify, Xero, which you mentioned, is an accounting software. So we like Xero as well. We actually have our own accounting software, but most of our clients use Xero or like QuickBooks or one of the free accounting software. Now, there's a misconception. People think that that's all they need. At the end of your year as a limited company, even if you've been putting all of your information into Xero, it doesn't automatically file it for you. You actually still have to prepare accounts, prepare all of the financial statements, and they have to be delivered to company's house at the end of each financial year, and separately to HMRC in something called a CT600. And that's what you pay your accountant to do. So if anyone ever sort of says, I don't need an accountant because I can just use this online software, actually, you probably do need an accountant still, unless you've got used to it yourself and you've done it for a few years, because your accountant is the one that will then actually put the figures from Xero or QuickBooks into the relevant fields on the right accounting sheet, and actually then take down and minimize all of your liabilities, put down what's an asset, and make your balance sheet look as good as it can, and then actually deliver those electronically to company's house and HMRC. Because if you do that late, you get fined. So you don't really want to rely on some software that you're not too sure yourself where you want to put it. You still have to export it all into something else. So I just wanted to make that point, because you mentioned Xero.
Yeah. Thank you.
But the good thing is that modern bank accounts now, so Barclays, HSBC, Santander, and payment gateways like Stripe, and a few others like that. I'm trying to think of some other ones, but I've forgotten. Barclaycard is the other very common one. And I think there's one called Square, which is a little plug-in for an iPhone that they're quite good. I've seen them around. They're all merchant gateways, so they'll charge you a transaction fee. So you're losing a small amount of profit. It's a tiny amount of a transaction fee, but it's worth considering. Yeah. They typically will then take between 2 and 3 business days to sort of 10 business days, depending on the merchant and your volume, to actually give you the money in your account. Bank accounts, obviously, it's instant. If you make a Bax payment, and say, for instance, I use my NatWest iPhone app to make a payment into a business Barclays account, it's within 2 hours, it shows it's there, immediate. And even then, you can then verify that someone sent the money. You can see it on their phone. So you kind of have a visual check that they've paid you. Then, of course, there's PayPal. PayPal, again, is fairly instant. So, but you'll be paying a certain amount possibly in transaction fee if you're doing it as a business. So with the bank, you're not really going to pay any transaction fee. With PayPal, it's instant. You might pay a fee, and it's whether or not PayPal will support it and that person has a PayPal account and you can verify it. With Stripe and the other merchant providers, you'll wait a little bit longer. You might pay slightly less in the transaction fee, but you are sitting around waiting for that money. So that's kind of the least productive way, but it's the most easy way to always make sure you can be paid or take cash.
And taking cash is it's sometimes the most inconvenient because no one carries cash anymore.
Yeah.
But it's
and
the
banks
least
dislike you banking cash. So banks will hate you if you come in at the business account and try and pay in cash on a regular basis, because the problem in the UK is now accounting for money in terms of money laundering and things like that. We have huge amounts of compliance. And even if you're just talking about a few £100 every week that you're taking in, the bank will still ask you, where's that money come from? And you have to be able to say, okay, it's from doing that. It's from my job. I provide personal training and they've paid it to me. It becomes very sticky water. And I think in the next few years, the UK especially will become more difficult for any small business to take cash, because they'll be required to check that they can verify where that money has come from and that the person paying them is who they say they are.
Right,
for instance.
So go cashless is the advice.
Cashless is the best way going forward. Yeah. And just try and, work with banks that have really good online banking apps. So Barclays app I know is really good. I don't support Barclays personally as a bank. I'm just saying I know I have experience with their banking apps. And all of their apps work really well. NatWest apps are very good. RBS apps are very good. HSBC, their online banking app, it's a bit clunky, but it generally does the job. Santander doesn't have a mobile banking app, I think, that works that well for business, but they're probably working on it. But their online banking through website is very good.
Yeah, they've recently updated it too, which is it's much nicer interface, but I have no issues with it. And like you say, it gives you a whole holistic view of all of your accounts, your personal and your business, which is very useful. I can't even remember. I think I was with Halifax, and I was so annoyed with Halifax's customer service, because I think I got the feeling that after they were acquired by Lloyd's, they just really suck at looking after the small business. That's the feeling I got.
Yeah,
and so when
they don't do business now. I think they've closed it. That's why they didn't want business. They wanted all the business banking to go through Lloyd's.
Exactly.
Sorry to cut you off.
No, that's it. Yeah. That's what I was told. And then I went to Santander and just got the best customer service, and the whole £100 for signing up thing. And and that was how they lured me in. Now, one thing you mentioned, which I think is important to talk about quickly, is finding an accountant, especially for the new business owners who are looking to get an accountant for the first time, or those that are consider switching accountants. Do you want to just talk about, expectations around costs for small businesses, but also how you might think about filtering when selecting an ideal accountant?
Okay. So the old-fashioned way for most people would be that you would go to an accountant that you can go and sit down to face-to-face, and they would be, and this is going to sound awfully rude, sort of fuddy-duddy, sitting in a small stuffy office with lots of books around. That's the old-fashioned accountant. They would charge you probably $500 just to have a chat with them, and then they'll charge you maybe £1,000 to £2,000 a year just to file very simple accounts. That's the old dated way. There's lots of companies now who will online, and they'll say, we'll file your accounts. And typically you'd expect to pay around £300 plus VAT if they've registered themselves. Maybe $500 if it needs to be done quickly, if you're close to your filing deadline. So that's the typical cost. And that's, for instance, what we charge. But we know we're about the same in the market for everyone. If you wanted advice from them, if it's a certified accountant, you are going to be looking at paying a certain amount, maybe $150 to $250 per hour, just for very simple accounting advice. Or you could do a deal with them where, for instance, they might give you unlimited amount of accounting advice through the year and file your accounts. And then you would expect to pay around £800 to £1,000 for the year. But that still gives you a lot of good value, because then they're there to answer the one-off questions throughout the year where you may want to know, should you then be enrolling in PAYE, for instance, if you want to take on a worker, or should you make that worker, for instance, self-employed themselves and make them a contractor to you? So your accountant would be there for all of those kind of questions. The other side of it is, for instance, if you wanted more business advice about growing your business, then there are business advisory companies, much like us, but there's quite a few of us dotted around. If If they happen to be local to you, you can go in and see them. That's great because it gives you face-to-face and you can have a bit more of a relationship with them. Typically, you do want to work with someone who will understand your business, will understand the implications for you as a director, and they should tell you that from very early on, that as a director, you're going to need to do X, Y, and Z, as well as your business needing to do X, Y, and Z. If they just focus on your business and they just say, give me the transactions and let me file it for you, then they're not really an accountant. They're just a piece of software. You see what I mean?
Yeah.
And there's nothing wrong with that too. But if you're a small business owner and you're starting up or you're transitioning and growing, I think it's really valuable to speak to someone who actually hands-on deals with those figures, deals with numbers, and deals with lots of different businesses that can say, okay, I would suggest you do this, or would actually say to you then, where do you want to be in a year's time or in 5 years' time? What kind of income do you want to be getting at some point? We're not going to help you market your business, but we can certainly help you plan your business better. And that's really what it comes down to, is looking at accountants who can also help you plan your business. They're your friends for life.
Awesome. Those ones you mentioned right at the start, the cheapest options, or I should say the least expensive options. What are the names of some of the ones you might recommend in terms of the online services? Is there any that come to mind?
What do you mean? Of software providers?
Right.
Accounting.
Yeah, for like the £300 to £500 a year service.
Well, I'm always going to say ours, aren't I?
Oh, right.
That's what we do. Formations House is what we do.
I didn't know that was part of your thing. Okay.
It is. So we file around 2,000 accounts a year, actually. So we have a couple of larger customers that we do all of their. So we do everything from their VAT, their PAYE, payroll, everything for them. We have clients who are restaurants, we have clients who are personal trainers, who are gyms, who are franchises, who are branches. But we also have small startups, and they make 20 transactions through a whole year, and they send me the list, and I'll still look at it and say, okay, what was this here? Because I think we could put this in a different bracket or in a different part of the accounting software. Mm-hmm. So we still actually take a look at every single accounts that we file and see if there's something we can do to optimize the business. And then lots of our clients do come in and see us and sit down and spend some time. We do charge a certain amount for advice, but then what you get is a kind of documented, this is a strategy for you based on what you said you want to do. This is what we suggest you do for the next 2 years. And it's kind of nice and clear cut, explains all of the business. There are other accountants like us. We're based in London, but there's lots around. Actually, can't think of any off the top of my head. Sorry.
Right. No. Why would you?
but there are. But you would search. You would just do a Google for company accountants, small business accounting, and then find one of those and see if one was friendly and approachable.
Well, it's probably an ideal time to start to wrap up and also capture your service and your company details, Charlotte. But before we do that, is there any kind of words of wisdom or parting advice that you want to leave the UK kind of fitness business owner with, in terms of anything we haven't touched on with regard to managing their accounts that might be important?
I think the key thing is, firstly, I think in 9 out of 10 environments, having a company is better. I really do believe that having a limited company is better, even if the cost of administrating that may seem a little bit higher than being a sole trader. I think it gives you a better level of protection. But the key when you do have a limited company is don't miss your filing deadlines, don't miss your accounting dates, because your penalties from Companies House are quite high and you don't want to get fined. And a lot of people don't realize how important it is. You cannot be even 1 day late without getting a fine. You're talking £150 minimum going upwards. So it's really worth making sure you keep an eye on your dates and talking to your accountant as regularly as you need to. That's what they're there for.
Well, good advice. And do you want to just elaborate on, the service you provide, and also how the listeners can find out more about you and get in touch if they're interested?
Sure. So we are a London-based formation agent and accounting provider. So we do company formations of all types in the UK and around the world. So it's standard limited companies. And our basic packages are from £20 up to £100 maximum, which includes kind of all the documents and everything that you would want. We're on hand to also advise on which business banks might be best for you, depending on where you're based and what you want to do. And then we work all the way through with you to filing your accounts every year. We can also do your self-assessment filing for you, or answer for any questions on that. If you, for instance, want to take investment or anything like that, we can again assist you with that. And we also have a business planning arm. So if you wanted to come in and actually chat about your business, potential pitfalls or where to grow it, we're very happy to see people and let them come in and talk to us face to face. Our website, however, does have lots of information on it, and it's very simple: formations.house. It's literally, says what it does. And you can visit us and call us. We're here pretty much every day. Unlike a lot of other formation agents as well, we are only UK based. And I think that's quite an important thing to say, that everyone that works for us is just here in the same office. We don't have any overseas call centers or anything like that. And we offer a full suite of other business services. So we do things like virtual office. We can do receptionist services. So for instance, if you wanted a London number or a Brighton number or anything like that, we can get you a business number and we'll answer the calls for you in your name and then send you the messages to call the clients back. So it's a really nice way if you wanted to promote your business as being a little bit bigger than perhaps it is, but you don't want to have a huge cost to do so. We can help you do that. So get in touch.
Awesome. Thank you very much, Charlotte. And to find, for those listening, to find the blog post for this episode, please go to corporatewarrior.co/accountants. I just came up with that and I should have probably come up with something previous. And for all episodes, please go to corporatewarrior.co/podcast. And until next time, guys, thank you very much for listening.
Discover how to improve health, become a great personal trainer, and build a successful high-intensity strength training business. Check out corporatewarrior.co. corporatewarrior.co.
This episode is brought to you by ARX, the most innovative, efficient, and effective all-in-one exercise machines I have ever seen. I was really impressed with my ARX workout. The intensity and adaptive resistance was unlike anything I've ever experienced. I love how the machine enables you to increase the negative load to fatigue target muscles more quickly, and I love how the workouts are effortlessly quantified. The software tracks maximum force output, rate of work, total amount of work done, and more in front of you on screen, allowing you to compete with your previous performance to give you and your clients real-time motivation. The ARX uses a computer-controlled motor to give you the exact amount of resistance your clients need 100% of the time. This means that the resistance can never become dangerous, is intuitive and simple to use, and can provide you with all of the results you and your clients are looking for in a fraction of the time. ARX is highly effective and efficient in delivering all of the benefits of exercise, including increased strength, muscle mass, cardiovascular conditioning, bone mineral density, and injury recovery. As well as being utilized by many high-intensity trainers to deliver highly effective and efficient workouts to their clients, ARX comes highly recommended by world-class trainers and brands, including Bulletproof, Tony Robbins, and Ben Greenfield Fitness. To find out more about ARX and get $500 off install when you place an order, please go to arxfit.com and mention Corporate Warrior in the How Did You Hear About Us field. So again, to get $500 off install when you order, head on over to arxfit.com and enter Corporate Warrior in the How Did You Hear About Us field.